What if I told you that the Oracle of Omaha himself, Warren Buffett, has a blueprint for not just surviving, but thriving during periods of high inflation? Imagine being able to grow your wealth even as rising prices eat away at the value of your cash. In this video, we'll dive deep into Buffett's inflation investing pyramid and extract his key principles for getting ahead while the cost of everything around you skyrockets. Are you tired of watching your hard-earned dollars evaporate as inflation spirals out of control? Do you want to position your portfolio to benefit from rising prices? Then you've come to the right place. Stay tuned as we unpack Buffett's timeless wisdom on this critical topic. Starting with Buffett's inflation investing pyramid. At the start of Buffett's approach is what he calls the investor's protection against inflation pyramid. This framework categorizes investments from worst to best during inflationary environments. Number 1. Assets denominated in currency like cash and bonds. These are the worst assets to own as inflation erodes their value. Money sitting in a bank account or under your mattress will get eaten away month after month. Bonds with coupons in the inflated currency will struggle too. If you lend $100 at a 10% annual rate, but inflation is also 10%, you make no real return. Number 2. Unproductive assets, for example, art and gold. While they may keep pace with inflation, they don't generate real returns. As Buffett explains, if you owned all the gold in the world, you could have a cube that's about 67 feet on one side, but it isn't going to do anything. Can you imagine having a piece of gold that big and it's still serving absolutely no real purpose? 10 years later, your rare painting is still just a rare painting. To profit, you'd have to foresee how scared of inflation people will be in the future and work out a value from that, a challenging metagame. Number 3. Mediocre productive assets. These are businesses that require heavy, ongoing investment just to maintain earnings. Their costs rise with inflation. As Buffett puts it, the worst kind of business is one that makes you put more money on the table all the time and doesn't give you greater earnings. Think low returns on tangible assets, no pricing power, and lots of cash and bonds on the balance sheet. Many businesses, like banks and insurance companies, fit the mold. But also, small businesses like grocery stores, local cafes, and restaurants. While the costs continue to rise with inflation, making your business less attractive to customers, the profit margins generally stay the same. Number 4. Great productive assets. These are companies with strong brands, pricing power, and low capital requirements that can increase earnings faster than inflation. The opposite traits of mediocre businesses. If you own some businesses that required very little capital investment and had real flexibility of price during an inflationary period, and you leveraged it, then you might even beat inflation to some extent. Software companies and iconic consumer brands belong here. Real estate and farmland can also fit, though they have some ongoing capital needs. But the best examples of this are digital assets. Imagine creating an online course that stays relevant to future consumers for a long time. Once the course is made, there are very few costs to continue selling it. You also have the option to increase prices to match inflation, meaning your profits never decrease. Think about all the content creators and online course operators you see out there on YouTube. As Buffett explains, if you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end. In contrast, a productive business can compound earnings over time. Number 5. Your own earning power. Mainly, developing valuable skills is the best hedge, as your earnings rise with inflation. If you're the leading brain surgeon in town, you don't have to keep re-educating yourself. You retain your earning power in current dollars. By providing value to others, you'll always command a portion of their output, regardless of the currency. That's what makes you, yourself, the most important investment. What are the actual traits of inflation-resistant businesses? So, what separates a great business from a mediocre one when prices are soaring? To follow Buffett's example, he looks for companies with low capital requirements and high return on assets, pricing power to raise prices without losing customers, little need for cash, and some financial leverage. The best businesses during inflation are those that require little additional investment to maintain their earnings power. Think of strong consumer brands like Coca-Cola or capital light software companies. In contrast, the worst are those, like utilities, that must continually invest more and more just to stay in place. Their earnings may go up, but they're compelled to put more dollars into the business just to stay in the same place. Another key trait of inflation-resistant businesses is a culture of continuous cost improvement. Companies that are always looking for ways to streamline operations, reduce waste, and boost productivity will be better positioned to maintain margins when costs rise. This requires a proactive, forward-thinking management team that embraces change and innovation. Finally, businesses with diversified revenue streams across different geographies, customer segments, and product lines tend to be more resilient. They are less vulnerable to inflationary pressures that may impact certain areas of the economy more than others. Consider the breadth and balance of its earnings drivers. Ever heard of the power of financial leverage? Buffett points out how businesses and individuals can benefit from higher inflation if they use leverage prudently. If you own a home with a large mortgage and high inflation wipes out the mortgage, you've still got the home. In Weimar, Germany, they give you the mortgage back at the end. Of course, leverage is a double-edged sword that amplifies both gains and losses. But Buffett suggests that financing long-term assets with fixed-rate debt can provide a tailwind during inflationary times. The key is to borrow wisely and invest the proceeds in productive assets that will appreciate faster than the rate of inflation. For example, a company might issue bonds to finance a new factory equipped with state-of-the-art automation technology. The efficiency gains could boost profits enough to more than offset the interest expense, while the debt principal gets inflated away over time. Individuals can apply similar principles by taking out a mortgage to buy a home or investment property, or even borrowing to invest in a diversified portfolio of stocks. The caveat is that you must be able to comfortably service the debt and ride out any short-term volatility. Excessive leverage can be disastrous if asset prices decline or cash flows dry up. So what's the ultimate inflation hedge? Above all else, Buffett believes that maximizing your earning power is the very best way to keep ahead of inflation. The best investment by far is anything that develops yourself. If you're the best brain surgeon in town, you will command a given portion of the goods and services of other people, no matter what the currency is. Unlike a bond or cash, your skills can be inflated away. If you took on student debt that's now easier to pay off, all the better. Focus on providing value to others, and your earnings will rise accordingly. This insight has profound implications beyond just investing. It suggests that the most important asset we can cultivate is our human capital, our knowledge, skills, relationships, and creativity. These are the ultimate drivers of wealth creation and the most durable protection against economic upheaval. So while it's prudent to structure our finances to weather inflation, the highest leverage investment is in our capabilities. Continuously learning, growing, and finding ways to serve others more efficiently is the surest path to long-term prosperity in any economic climate. As Buffett quips, if you're the best brain surgeon in town, you don't have to keep re-educating yourself to be that in current terms. Buffett sure does love a good brain surgeon analogy, doesn't he? Let's put it all together for you. Number 1, avoid assets denominated in currency that lose purchasing power. Number 2, favor productive assets, especially high-quality businesses with pricing power. Number 3, use leverage prudently to finance long-term productive assets. Number 4, develop valuable skills to maximize your earning potential. This doesn't mean you need to shun cash or bonds. They still play a role in providing liquidity and stability. The key is to concentrate your long-term wealth into productive assets. As Buffett reminds us, inflation is a far more devastating tax than anything that has been enacted by our legislature. But by following these time-tested principles, you can aim to not just preserve, but grow your purchasing power over time, no matter what the economic climate. While inflation can be challenging, Buffett remains ever optimistic. I'm very optimistic about life. If I can be optimistic when I'm nearly dead, surely the rest of you can handle a little inflation. So there you have it. Warren Buffett's game plan for not just surviving, but thriving during inflation. By focusing on productive assets, using leverage wisely, and most importantly, investing in your skills and abilities, you can aim to grow your wealth, even as rising prices erode the value of cash. Remember, the best investment you can make is always in yourself. Start putting these strategies into action today, and position yourself to profit while others merely try to keep pace. If you found this video helpful and want to learn more timeless wisdom for mastering your money and building a life of true abundance, be sure to smash that subscribe button and hit the notification bell so you never miss a new video.